Have you heard about mortgage points and wondered if they're a good deal? Mortgage points can be a great way to lower your interest rate, but whether or not they're worth it depends on your financial goals and how long you plan to stay in the home. Let's break down how they work and when it makes sense to buy points. Mortgage points, also known as discount points, are essentially prepaid interest. When you buy points, you pay a certain amount up front in exchange for a lower interest rate on your loan. Each point typically costs 1% of the loan amount and reduces your interest rate by about a quarter percent. So for a $300,000 mortgage, 1 point costs $3,000 and might lower your rate from, say, 5% to 4.75%. The main benefit of buying points is the long-term savings. With a lower interest rate, you'll pay less in interest over the life of the loan, which can add to significant savings, especially if you plan to stay in your home for many years. However, you need to weigh those savings against the upfront cost of the points. The key question is, how long will it take to break even? You can calculate your break-even point by dividing the cost of the points by the monthly savings from the lower interest rate. If you plan to stay in the home longer than the break-even point, buying points could save you money in the long run. But if you think you might move or refinance before that point, it might not be worth the upfront cost. One thing to keep in mind is that points are tax deductible as mortgage interest in the year you pay them if you're buying a home, which could help offset some of the cost. Ultimately, whether or not to buy points depends on your long-term plans and financial situation. If you're considering buying points or have questions about how much they could save you, let's connect. I'd be happy to help you figure out what makes the most sense for you.